Welcome to our in-depth guide on trading strategies using the OSPiC system, enriched with John Persons and Camarilla pivots. Before we dive into the mechanics of entries and exits, it's crucial to understand the mental framework behind OSPiC. This framework is more than just a set of rules. It's a mindset that every successful trader needs. OSPiC stands for observation, simplicity, patience, and context. Let's break down each component and see how it shapes effective trading. 1. Observation. Understanding market signals. Many traders look at charts but don't truly observe what the market is saying. They often hope for certain outcomes rather than analyzing the data objectively. Observation is about seeing what's actually happening in the market, not what you wish to see. It involves keenly watching price action, volume, and market structure to make informed decisions. Practical application. Apply this by focusing on how price reacts to key levels, analyzing dark pool data for institutional activity, and being aware of the broader market context. This allows you to make decisions based on facts rather than hopes. 2. Simplicity. Avoiding overcomplication. Traders often complicate their strategies with excessive indicators and convoluted plans. This complexity can be seen on the charts and in their trading approaches. Simplicity means focusing on core principles and avoiding overanalysis. It's about streamlining your strategy to what works. Practical application. Simplify your trading plan by focusing on a few key indicators and rules. Use OSPiC principles to keep your approach straightforward and effective. 3. Patience. Waiting for quality setups. Traders often lack patience, leading them to chase trades, overtrade, or rush their process. Patience involves waiting for high-quality setups and sticking to your trading plan without impulsively reacting to market noise. Practical application. Wait for ideal entry points and allow trades to develop according to your plan. Avoid the temptation to trade out of impatience. 4. Context. Trading within a framework. Traders must understand the context in which they are trading. This includes the chart's time scale, their emotional state, and the overall trading plan. Context is crucial for making informed decisions and managing risk effectively. Practical application. Ensure your trades are aligned with the broader context of the market. Adjust your strategy based on the timescale you are trading, your current emotional state, and your overall trading plan. With the OSPiC framework as your foundation, we can now delve into the specifics of entry and exit strategies using the OSPiC system, combined with John Persons and Camarilla pivots. This approach ensures that every decision you make is grounded in solid observation, simplicity, patience, and context. Welcome to our comprehensive guide on trading strategies using the OSPiC system, enhanced with John Persons and Camarilla pivots. This guide will cover detailed steps for analyzing entries and exits, integrating institutional liquidity, and leveraging pre-market volume effectively. Let's dive in. First, let's focus on entry analysis with OSPiC. Start by confirming institutional liquidity. 1. Institutional liquidity confirmation. Identify key liquidity levels. Use dark pool data to pinpoint price levels with significant institutional activity. Concentrate on high volume levels where substantial trades occur. Volume profile. Examine volume profiles to find where volumes are high. These areas often align with institutional interests, serving as critical support or resistance. 2. Technical indicator alignment. Price action. Observe how price interacts with identified liquidity levels. Watch for breaks or reversals. Moving averages. Ensure the stock trades above or below key moving averages. For a bullish entry, the price should be above the moving average. For bearish, below. MACD. Check for MACD crossovers. A bullish crossover near a key liquidity level signals a strong buy. RSI. Confirm RSI is neither overbought 70 nor oversold 30. An RSI around 50, combined with institutional buying, strengthens your entry signal. Bollinger Bands. Consider entering when the price breaks out of the bands, especially with high institutional volume. A breakout above the upper band with increased dark pool activity signals a strong move. 3. Contextual confirmation. Elliott wave. Align entries with the Elliott wave count. Enter during a wave 3 uptrend or wave 5 bullish phase for optimal timing. Ichimoku cloud. Enter when the price is above the cloud, bullish trend, or below, bearish, particularly if institutional data supports this direction. 4. Entry timing. Breakout points. Enter when the price breaks above resistance levels, confirmed by high dark pool activity. Place buy orders just above these levels. Pullbacks. Consider entering during pullbacks to significant support levels, especially when confirmed by institutional data. Now let's move to exit analysis with OSPiC. 1. Profit-taking points. Resistance levels. Identify significant resistance levels using dark pool data. Consider taking profits as the price nears these levels. Technical indicators. Monitor indicators like moving averages and MACD. Exit if the price crosses below key moving averages or if MACD shows a bearish crossover. 2. Stop loss adjustment. Reevaluate stops. Adjust stop loss orders based on liquidity levels. Tighten stops if the price approaches key support with increased institutional selling. Trailing stops. Use trailing stops to lock in profits as the price moves favorably. Adjust stops based on market direction and institutional flow. 3. Monitoring institutional activity. Volume changes. Watch for significant changes in dark pool activity. Increased selling might indicate a reversal or trend change. Liquidity shifts. If dark pool data shows a shift in liquidity away from your position, it might suggest weakening momentum. 4. Exit timing. Price targets. Set price targets based on resistance levels and historical action. Exit when these targets are reached, especially if accompanied by institutional selling signs. Reversal signals. Be prepared to exit if reversal patterns or bearish signals appear from technical indicators, such as an RSI moving into overbought territory and turning down. Integrate John Persons and Camarilla pivots into the OSPiC system for refined entry and exit strategies. 1. Identify pivot levels. John Persons pivots. Calculate and plot pivot point, support 1 to 3, and resistance 1, 3 based on the previous day's high, low, and close. Camarilla pivots. Apply L1, L4 for support and H1, H4 for resistance, calculated similarly. These are useful for intraday trading. 2. Confirm entry points. Breakouts. Look for price breakouts above resistance, Persons or Camarilla H3, H4, or below support, Persons or Camarilla L3, L4, with confirmation from dark pool data. Pullbacks. Enter during pullbacks to pivot levels acting as support or resistance. Confirm with bullish signals from dark pool data. 3. Alignment with other indicators. Combine with technical indicators. Align pivot points with moving averages, MACD, RSI, and Bollinger Bands. For instance, if near a Camarilla pivot and the MACD shows a bullish crossover, it reinforces the entry signal. Elliott Wave and Ichimoku Cloud. Ensure pivot levels support the Elliott Wave count and Ichimoku Cloud signals. 4. Exit strategy. Profit taking. Set targets at pivot resistance points. Exit near John Persons R2 or Camarilla H3, H4, especially if reversal signs appear. Stop loss adjustment. Place stops just below key support pivots and adjust as the price moves. Use trailing stops aligned with pivot levels. Exit timing. Monitor reversal patterns around pivot levels and adjust stops and targets based on market conditions. Finally, let's discuss timescales and integrating pre-market volume into the OSPiC system. 1. Timescales. Short term. For day traders, use 1-minute to 30-minute charts. Focus on intraday dark pool data and Camarilla pivots for precise entries and exits. Medium term. Swing traders should use 1-hour to daily charts. Combine dark pool data, John Persons pivots, and technical indicators to capture intermediate trends. Long term. Position traders use daily to monthly charts. Long-term dark pool data and historical pivots help identify major trends and support resistance levels. 2. Pre-market volume. Identify high-volume stocks. Use pre-market scanners to find stocks with volumes of 250,000 shares or more. High pre-market volume indicates significant interest. Check for news. Look for news catalysts driving the volume. Understand the events to gauge potential price movements. Integrate with OSPiC. Combine pre-market volume with dark pool data, pivot points, and technical indicators. Enter near pre-market highs or pullbacks to support levels. Monitor during market open, observe the opening range, and adjust stops and targets based on real-time data. By integrating institutional liquidity, pivot points, and pre-market volume with the OSPiC system, you can enhance your trading strategy for more informed and timely decisions. Remember to continually review and refine your approach based on performance and market conditions. Thank you for watching. Subscribe for more trading insights and strategies. Happy trading!